Hi everyone, welcome to the Wiseman Financial Services video blog. In the world today, there are many issues that can keep you up at night. That could be something like terrorism, Brexit, climate change, war with China, Chinese debt, Sydney property booms, Russian hackers, ultra-low interest rates, and US presidential elections. The latest big one is the woes of Deutsche Bank. The German government at this stage is not proposing a bailout of the German bank, which would kind of be like our Commonwealth Bank, not the Reserve Bank. So what does this matter to us? Well, there are a few commentators and analysts pointing to the similarities to a Lehman Brothers type of event repeating itself. This is because of how interconnected Deutsche Bank is to the rest of the finance world. As you can see, Deutsche is considered to be a global systemic investment bank. The share price has certainly taken a tumble, and along with banks in the Italian banking system, the concern is that we see contagion across the financial sector, eerily similar to the GFC. So, what should you do with your money? Should you park it under the bed, put it in the bank, or one option often suggested is to try and hide out in gold? There are a few reasons why gold is considered to be a good thing. One of them is when the world is experiencing tumultuous events, gold is often seen to respond differently to those financial events. As such, people can reduce their exposure to risk on other assets. So your shares or property go down, your gold goes up. So far this year, the returns have been pretty good. However, the turnaround can be pretty quick, as we've seen recently. People that are often promoting the benefits of owning gold are often referred to as gold bugs.
I love gold!
Now, if one of those gold bugs are watching this video, they will be the ones more than likely to leave a comment. In some cases, a derogatory one. Since the GFC, alternative assets such as gold have been introduced a lot more in superannuation funds for the purposes of diversifying. Gold is seen to be a real asset that you can touch. Well, yeah, it's a real asset, but it's not much good to you whilst you are holding it, unless it's for a paperweight or a doorstop. You have to sell it to realise the profit or loss. You are speculating on the price going up or down. Let's look at an alternative. In the week ending the 30th of September, there had been $7 billion in dividends paid from Australian shares to investors, and the week after that, there was another $4 billion. So the share prices can go up and down in value, but a lot of them provide an income that can be either reinvested, or you can decide for that to go into your bank account. But let's just say your preference might be to invest into those assets that don't produce an income and just go for growth. So let's say you bought gold and you held it for a long period of time to make the most of the growth. Okay, so let's have a look at this and compare it to the Dow Jones in 1979. So, $1,000 invested into gold in 1979 is worth around $1,300 today. $1,000 invested into the Dow Jones in 1979 is at $18,000 today. That's a pretty horrible return for gold over the long term, but yeah, that's in the past and things might change. There are other issues for Australian investors into gold. The gold price rallied significantly in the 2000s, but because it's quoted and traded in US dollars, and as the Aussie rose against the US dollar at the same time, Australian investors didn't get anywhere near the same return. There are now products out there that will help you hedge against the rise of the Aussie dollar, so that could help in the future as well. Another issue in buying gold is that a lot of people think that owning a gold mining company is going to provide you with the diversification. But that's not buying gold for the purposes of diversifying and hedging against hyperinflation or global catastrophes. You are buying a business that digs something out of the ground, which just happens to be gold. There are a host of other issues that you are potentially buying into, like equipment failure, rising wages, transport issues, company mismanagement, or government decisions that affects your business. The Oceana Gold Company has copped a hammering after the Philippine government forced the closure of their gold mine. Government interference is often quoted as one of the reasons to be buying gold. If this is the vehicle you choose to buy your gold, then you may not be getting the real benefits of owning that asset. You could buy gold bars from somewhere like the Perth Mint, but if you're going to own the physical asset and you want that as part of your self-managed super fund, then you must comply with the ATO rules regarding collectibles and personal use assets. There are other ways to get exposure to gold, which is considerably easier than complying with the self-managed super fund rules, and that is through ETFs. But you have to be careful with that as well to see what the ETF is actually investing in. Is it the gold bars, or is it a futures or derivatives contract? This can be different again to what you think you're investing into. Now, as soon as I post this video, gold will probably shoot up more just after I've stuck my neck out to bag it. Differing opinions is what makes a market. But if you're compelled to buy gold and the price goes up, if you look at history, you have to be prepared to trade the asset at the right time to actually get the return. Not even a billionaire investor like John Paulson, who successfully traded and made a name for himself predicting the GFC are immune from being stung by gold. And remember, always make sure you know what you're buying. If you're unsure, get in contact with your advisor to discuss it further. If you're still awake, thanks for taking the time to listen.